monetary policy and oversees more than 1,000 employees based at the bank's Cleveland office and branch offices in Cincinnati and Pittsburgh, who conduct economic research, supervise banking institutions, promote community development, and provide payment services to depository institutions and the U.S. Treasury. President Mester represents the 4th District on the Federal Open Market Committee. She began her career at the Federal Reserve Bank of Philadelphia in 1985 as an economist and was the Executive Vice President and Director of Research at the Federal Reserve Bank of Philadelphia prior to her appointment as President and CEO at the Cleveland Fed in 2014. And as I recall, her keynote remarks with us at this event in 2015 were President Mester's first official speech. President Mester is an adjunct professor of finance at the Wharton School of the University of Pennsylvania, where she also taught in the undergraduate finance and MBA programs at the Wharton and the PhD program in finance at New York University. She is very, very engaged in the Cleveland community, active with the Cleveland Partnership, the Municipal Arts Association, and the Cleveland Clinic. I promised her I would keep the bio brief, but to wrap it up, just to further show her bona fides here, President Mester graduated summa cum laude with a Bachelor of Arts degree in Mathematics and Economics from the Barnard College of Columbia University, and she earned her MA and PhD degrees in Economics from Princeton University, where she was a National Science Foundation Fellow. Please join me in welcoming Federal Reserve Bank of Cleveland President Loretta Mester.
Well, thanks very much, Michael, for inviting me to speak today, and thank you all for being here. I really appreciate it. And before I go on, I want to just say that the views I present today will be my own views and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So the last time I spoke at an OBL event was in September 2021. Of course, it was a remote event at the time. And, I'm always trepidatious to go back and look at, things I said in the past. You have to have kind of a steel will to do that, but I did it anyway. And, at that time, the economy was in recovery. A strong recovery was underway, but it was an uneven one. And there were still many challenges and risks, including the Delta variant of the coronavirus, which was emerging at the time. People were starting to return to the workforce, but only pretty slowly. And the number of payroll jobs and the labor force participation rate were still well below where they were prior to the pandemic. The unemployment rate was down from its peak of nearly 15%, where it peaked early in the pandemic, but it was still near 5%. Inflation moved up, it was already over 4%, and it was expected to rise further from that level and remain elevated until supply constraints and pent-up demand eased, and it was assumed that that would take some time. And monetary policy had not yet begun to tighten. So, of course, the economy and monetary policy have certainly been on quite a journey since that time. And if I had to characterize both today, I would say that the economy and monetary policy are in a good place. Inflation's still above our goal of 2%, but it's moved down considerably from the high level in 2022, and labor markets and economic growth remain strong. The FOMC's job now is to ensure that the economy reaches an even better place by calibrating monetary policy to achieve our dual mandate goals of price stability and maximum employment. And in order to do that calibration, we need to continue to monitor and assess incoming economic and financial information and its implications not only for the baseline forecast, but also for the risks around that forecast. So risk management will take center stage. Now, bankers have played a very important role in determining where the economy is today and where it's going. And by providing valuable credit, risk management, liquidity, and payment services to your customers, you support a strong economy. Ohio bankers supported families, businesses, and communities throughout the pandemic, and they continue to do so even as the industry faces its own challenges. And I want to thank you for managing through the balance sheet impacts of the sharp rise in interest rates over the past 2 years and the liquidity stresses that manifested themselves last March. Just as the Fed will be carefully managing risk and determining its appropriate policy stance, banks are going to need to do so as well, so that they can continue to contribute to a strong economy. I also want to thank the bankers in Ohio and throughout the 4th District for the timely information and insights on the economy and banking conditions that you've provided to me in my role as a Federal Reserve policymaker. Now, several of the Cleveland Fed's current and former directors and members of our Community Depository Institutions Advisory Council, or CDAC, are here today. And they can attest to the fact that, there's a rich set of insights provided to the Fed by our bankers. And that information plays a crucial role in helping us better understand what's really happening on the ground in real time and what could be coming. So let me turn now to my assessment of where the economy and monetary policy are and where they're likely going. Over the past 4 years, the pandemic and its aftermath have been the major forces shaping economic developments and the major sources of uncertainty about the economy. When the pandemic hit, the economy shut down in March 2020, and fiscal and monetary policy makers took aggressive actions to support households and businesses, ensuring that credit continued to flow and limiting lasting damage to the economy. The economy began to reopen in May 2020 when public health statistics began to improve, but it wasn't business as usual. The pandemic had affected global supply chains, the supply of and demand for labor, and the composition of household and business spending on housing, goods, and services. Imbalances between supply and demand in both product and labor markets led to significant upward pressure on prices, and inflation began to rise in April 2021. Russia's invasion of Ukraine in February 2022, which is an ongoing human tragedy, added to inflationary pressures, spurring higher prices for oil, food, and other commodities. In 2022, headline inflation reached levels not seen in 40 years, running 7 to 9%, depending on the measure. And in response, the FOMC began raising its policy rate, the federal funds rate, in March 2022. And over the 2 years since, the committee has significantly tightened the stance on monetary policy by raising the Fed funds rate by a cumulative 5.25 percentage points. The Fed's also reducing the size of its balance sheet by allowing assets to roll off in a systematic way, according to the plan we announced in May 2022. Now, the tightening of monetary policy has led to a broader tightening of financial conditions over time, and in response, aggregate demand has begun to moderate. In addition, the supply side of the economy has been healing. Supply chain disruptions and bottlenecks have improved significantly, and firms have invested in diversifying their supply chains, making them more resilient to disruptions. Growing tensions in the Middle East might undermine supply chain improvements, but our business contacts tell us that so far there's been only minimal effect on their operations, and that they expect the increase in shipping costs through the Red Sea to be temporary. But this is a risk worth watching. Now, the pandemic had profound effects on the labor markets, but the labor market is normalizing. People have returned to the labor force over time, and the labor force participation rate of people aged 25 to 54 is now slightly above its pre-pandemic level. Over time, the imbalances between supply and demand in both product markets and labor markets, which help fuel high inflation, have lessened, and inflation has moved down. This disinflation has happened even as the economy has remained very resilient, with both economic growth and the labor market outperforming relative to expectations. And I'm sure you'll recall many CEOs and economists thought that the growth last year would be below trend. I was one of them. The Fed forecasts were below trend. But the economy didn't agree. Real GDP growth in the fourth quarter stepped down from its very strong pace in the third quarter, but was still a solid 3.25% annual rate. Growth last year is estimated to have been a bit over 3% for the year as a whole, which is above my 2% estimate of trend growth. Now, the change in firms' inventories was expected to subtract from growth last quarter, but instead it made a slight positive contribution. But even excluding the change in inventories, growth in final sales was quite strong. Consumer spending makes up about 70% of GDP. Strong income growth and healthy balance sheets have contributed to continue to support household spending, and the savings rate has moved below its pre-pandemic level, reflecting that strong spending. So it's interesting that despite the economy's strong performance, including strong consumer spending, until recently, surveys of consumer sentiment basically indicated that most people were not very happy about the economy. And I believe that partly reflects the fact that even though inflation has been coming down and wage gains have been high, many people's wages have not kept up with inflation. When inflation persists at levels above our goal of price stability, the price level is moving up faster than we'd like, and households and businesses have to pay those higher than expected prices, higher than desired prices. With inflation moving down, wages adjusted for inflation have begun to move up, and that's helping to close the gap between the cumulative increase in inflation and the cumulative increase in wages. And that may be partly why consumers are feeling better about the economy now. I expect household spending to moderate somewhat this year. In the wake of high prices, many families, especially those at the lower income families, have spent the savings accumulated during the pandemic. And there's been an uptick in credit card debt, suggesting that some households have exhausted their ready cash balances. Delinquencies on consumer loans have also edged up, although they are still at low levels. Now, the tighter financial conditions we have restrained investment in housing and business spending. Businesses slowed their spending on equipment and software last year, and it's expected to continue to moderate given restrictive credit conditions. The regional manufacturing surveys from the Federal Reserve Banks and the National ISM survey indicate weaker manufacturing activity. Now, the 4th District manufacturers tell us that their order backlogs are diminishing. So that's consistent with slowing activity in the manufacturing sector. In the housing market, residential investment declined in 2022 and was flat last year. Sales of existing homes are at low levels, but sales of new single-family homes were fairly resilient given the longer-term shortage of available housing. Now, the shortfall in housing supply has kept home prices relatively high, especially given where interest rates are. But rents, especially for new tenants, have moved down, and that should lead to a continued tempering of inflation in housing services. Last Friday's labor market report for January shows that the labor market has been remarkably resilient. Payroll job growth rose by about 350,000 jobs in January. And even if some of that reflects seasonal adjustment issues, it was an unexpectedly strong reading. In addition, job numbers for October, November, and December were revised up. The unemployment rate has been 3.7% over the past 3 months, near a 50-year low. So that's really strong performance. Now, if you look at other indicators, they point to some moderation in the labor market. Our contacts tell us that except for the healthcare sector, it's easier to hire than it was a year ago, and that they're getting more applicants per job opening. The pace of job quits has also declined since peaking in 2022. Now workers are quitting jobs at about the same pace as before the pandemic, and the number of job openings has been declining. There are now about 1.5 openings per unemployed worker. That's above the level we saw in 2019, another period of strong labor market conditions. But it's come down a lot since March 2022 when we began to tighten monetary policy. And on the supply side, as I mentioned, the labor force participation rate of workers aged 25 to 54 is normalized. Now, as the demand for and the supply of workers have started to come into better balance, wage growth has moderated. Firms in our district are expecting wage increases to average about 4% this year, down from 5% a year ago, but still above pre-pandemic levels. The employment cost index rose at an annualized rate of 3.5% over the last 3 months of 2023, down from about 4.75% in the first quarter of last year. And the gap between wages of job switchers and job stayers in the Atlanta Fed's wage growth tracker narrowed last year to about its average over 2015 to 2019. So that's another sign that the labor market is coming into better balance. Now, current estimates of trend productivity growth suggest that the current level of wage growth is still a bit above the level consistent with 2% inflation. But the strong recent readings on productivity raise the possibility that trend productivity growth has moved higher than what it was before the pandemic. The scarcity of workers during the pandemic gave firms a greater incentive to do more with fewer workers, and many invested in automation. New technologies such as generative AI hold the promise of increasing productivity over the medium to longer run. If so, then wages would be able to rise at a faster rate and still be consistent with price stability. At this point, though, I suspect we will see further moderation of wage growth, with a gradual slowing in job growth and an uptick in the unemployment rate over the year from its very low level. Now, while inflation is still above the Fed's goal of 2%, the news on inflation is encouraging. Inflation moved down faster than expected last year, even as the economy remains strong. Measured year over year, as of December, total PC inflation is 2.6%, and core PC inflation is 2.9%. And over the past 6 months, the levels are even lower. Other measures of inflation, including the median and trim mean measures, have also moved down from their peaks. Now, when you ask retailers in the 4th District, they tell us that consumers are now more price sensitive than they have been. And many of our contacts across sectors have noted that after making price adjustments very frequently over the past 2 years, they've now reverted to their usual pre-pandemic practice of setting prices once a year, a sign of easing price pressures. The largest declines in inflation have come in goods prices. In fact, core goods prices have been declining as they were before the pandemic. Inflation in housing services measured by rents and the imputed rents for owner-occupied housing, and inflation in core services excluding housing, which makes up about half of the consumption basket, have eased less, but they have also improved over time. Now, there are reasons to be cautious in assuming that last year's rapid pace of disinflation will be maintained as inflation gets closer to the 2% goal. While restrictive monetary policy has played an important role in moving inflation down, supply-side adjustments were also important. Now that pressures on supply chains are approaching normal and the labor market is coming into better balance, we should not count on as much help from the supply side as we saw last year. Still, while inflation may prove to be more persistent this year, my baseline forecast is that under appropriate monetary policy, inflation will continue to move down over time to our 2% goal. Now, anchored inflation expectations are an important component of that forecast. Median and longer-term inflation expectations remain reasonably well anchored in a range consistent with the Fed's goal of 2% inflation. And 1 year ahead inflation expectations from the University of Michigan and New York Fed surveys have also moved down, although they're still about 1/4 to 1/2 percentage point, respectively, above their 2019 averages. Continued progress on inflation will help ensure that these expectations move down to our goal. And that progress depends on appropriate monetary policy. So as I'm sure you know, at its meeting last week, the FOMC decided to maintain the target range of the Fed funds rate at 5.25% to 5.5%, and to continue running off the Fed's security holdings. The FOMC judges that the risks to achieving its employment and inflation goals are moving into better balance, but it remains highly attentive to inflation risk. And the FOMC does not expect it will be appropriate to reduce the target range until it's gained greater confidence that inflation is moving sustainably toward 2%. Now, in making its monetary policy decisions, the FOMC is always guided by its strong commitment to achieving its congressionally mandated goals of price stability and maximum employment. When we began this tightening cycle, inflation was far above our goal and labor markets were strong. So it was clear we needed to focus on the price stability part of our mandate. Now, with inflation moving closer to our goal, we need to balance the risk to achieving both sides of our dual mandate when determining the appropriate stance of policy. It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. Doing so would undermine all of the good work that has gone into getting inflation to this point. On the other hand, if year-ahead inflation expectations continue to decline, maintaining the current level of the nominal Fed funds rate for too long would effectively be a tightening in our policy stance, which would pose an increasing risk to the maximum employment part of our mandate. Risk management will be the hallmark of monetary policy decisions going forward. Our job is to calibrate monetary policy to the evolving outlook and the risks around the outlook so that inflation returns sustainably to our 2% goal and labor markets remain healthy. My baseline forecast is that output and employment will moderate this year, and inflation will continue to move closer to our 2% goal over time. But there are a number of risks around that forecast. Heightened geopolitical tensions have potential implications for financial markets, oil prices, and global demand and supply. A continued easing in financial conditions could spur activity, leading once again to imbalances that fuel inflation. The stress generated by the bank failures last March has subsided. Many banks have diversified their sources of liquidity, making them less vulnerable. But stress could come again to banks that continue to rely on uninsured deposits for their funding while having sizable exposures to CRE assets that will need to be repriced at higher interest rates. Now, monetary policy transmits to the broader economy by affecting overall financial conditions, but the magnitude, speed, and duration with which it affects the economy vary with the nature of the shocks that have hit the economy and other aspects of the economic environment. So while labor markets are currently strong and are expected only to gradually moderate, we need to remain attentive to the possibility that conditions could deteriorate faster than expected. On the other hand, the strong output and employment growth could be an indication that the neutral rate of interest, which rose during the pandemic, might remain high, which would mean restrictive policy may be needed for longer to achieve our goals of price stability and maximum employment. No matter, monetary policy is in a good place from which to assess and respond to these risks of the outlook. The current strength in labor market conditions and the strong spending data give us the opportunity to keep the nominal funds rate at its current level while we gather more evidence that inflation truly is on a sustainable and timely path back to 2%. This is better than finding ourselves in a situation where we begin easing too soon, undo some of the progress we've made on inflation, potentially destabilize inflation expectations, and then have to reverse course. If the economy evolves as I expect, I think we will gain that confidence later this year, and then we can begin moving rates down. My base case is that we'll do so at a gradual pace so that we can continue to manage the risk on both sides of our mandate. Of course, if downside risk materialized, we would have the opportunity to move rates down more quickly, just as we raised rates more aggressively than usual to combat high inflation. Or if inflation appears to be stalling at a level above our goal, we'd have the opportunity to maintain a restricted stance for longer. Our policy actions will depend on how the economy and the risks actually evolve. When our goals of price stability and maximum employment are achieved, the economy will be in an even better place than where it is today. So let me conclude with some remarks about the Fed's balance sheet. As Chair Jay Powell indicated at his press briefing last week, the FOMC will be discussing reducing the pace of the runoff in its balance sheet assets at its next meeting in March. Since June 2022, the Fed's been allowing maturing treasuries and agency mortgage-backed securities to run off its balance sheet at a fairly good clip, according to the plan announced in May 2022. The Fed security holdings total about $7 trillion, and they've declined by about $1.3 trillion since the runoff began. We're implementing monetary policy via an ample reserves operating regime, in which reserve levels are ample enough that control over the federal funds rate and other short-term interest rates is executed primarily through the Fed's administered rates. And those are the interest rate paid on bank reserves, the interest rate offered on overnight reverse repurchase agreements, or ONRRPs, and the primary credit rate on discount window loans. Now, under this framework, active management of the supplier reserves isn't needed. As assets run off our balance sheet, Fed liabilities move down. So far, the balance sheet runoff has resulted in a reduction in ONRRPs, with balances currently under $575 billion, rather than a reduction in reserves. In the aggregate, reserve balances are about $3.5 trillion, which is about 15% of banking system assets. Now, what constitutes an ample level of reserves is uncertain. It depends on the banking sector's demand for reserves, as well as the distribution of that demand across institutions, which will evolve over time. The September Senior Financial Officer Survey indicated that for most banks, their reserve levels are above their preferred level of reserves, and money market rates and spreads suggest little in the way of funding pressures. In addition, the Fed's standing repo facility provides a backstop against such pressures. So the current level and distribution of reserves are more than ample. But as balance sheet runoff continues and ONRRP volume reaches a minimum level, reserves will begin declining too, and more redistribution of reserves will need to occur across institutions. As our balance sheet reduction plan noted, the FOMC will slow and then stop the runoff when reserve balances are somewhat above the level it judges is consistent with ample. And that's going to help ensure that we can continue to reduce our balance sheet to its efficient size for effectively implementing monetary policy and move toward our long-run goal of holding primarily Treasury securities, which will minimize the allocation of credit across sectors of the economy. Now, I want to note that the runoff pace pertains to how we implement monetary policy. It's not about the stance of monetary policy. Our main tool for monetary policy is the Fed funds rate target, and balance sheet runoff can continue even after we begin to lower the funds rate. So that concludes my prepared remarks. I want to thank you for your attention. I want to once again thank the bankers for doing all you can to support a strong economy, and I look forward to our discussion.
Great, Loretta. Thank you for your remarks, and I would be remiss if I didn't thank you for all you do to support the industry and ensure we've got a good, safe, sound banking system here, certainly in Ohio, throughout the 4th District, and the partnership that you have with Kevin Allard and his team at the state's Division of Financial Institutions. So thank you. Once again, a reminder, everyone, please take advantage of the microphones we've got available here to ask your questions. I've got a stack of questions, but I really want to hear what's on your minds as well. So I know some of you aren't shy, so feel free to make a beeline for one of those microphones while I ask a couple here. First of all, hard to believe you've been in this role for a decade already now, Loretta, and what would you say is your proudest moment, maybe?
I really feel it's been a real privilege to lead the Federal Reserve Bank of Cleveland, and I guess one of the proudest things I am is the great staff we have at the Cleveland Fed. No matter what area of the bank you look at, whether it be community development, economic research, the supervision and regulatory function that we have in the Fed, we do play an important role in payments, providing payment services to the U.S. Treasury. Every part of our bank, right, the staff is just first rate. So I'm very proud of the staff of the Cleveland Fed. One of the things I've tried to do is sort of pull back the curtain a little bit and make sure that I'm out and about in the district. Partly it's self-serving because I get a lot of good information about what's happening in the economy when I get to talk to people who are actually doing what the work of the economy is, rather than sitting and looking at data. It's really good to hear from a number of constituents, whether it be community development area, whether it be bankers, whether it be business people. And that's been instrumental in sort of making sure that we really understand what's going on the ground. And at the Cleveland Fed, we do a lot to try to make sure we have that reconnaissance. And if you've looked at the Fed's beige book, you'll see that we're including sections that really address some of the longer run issues that we're seeing in the economy, not just the point in time issue. So again, I'm very appreciative that I had the chance to sort of meet with the full group of people who make the economy run.
Awesome, thank you. Anyone? All right. What does the future of community banking look like over the next 10 years?
Oh, you guys should be telling me that. Look, I am a big advocate of the fact that the banking system is strong because of the diversity within banking. And personally, I think diversity is important in everything we do. I think diversity of views on the Federal Reserve is important. I think diversity of different backgrounds makes our work do. I believe that about banking too, right? Community banks really serve their communities. They do relationship lending, which is crucially important. They've been actually were instrumental in making sure that households, businesses, and communities overall got through the pandemic, and I think that'll continue to happen. I think there are some challenges that the community banks face. I mean, certainly every organization faces, potential, cybersecurity issues, technology can help in that, but those technology costs, right, add to the bottom line. So I do think that probably the size of community banks will have to continue to get a little bigger than where they are currently. But again, right, the vital role that community banks play in the economy, I don't think can be understated. It's very important that we have community banks serving underserved communities, underserved people, underserved households, and I think that is the future, right, is to continue to have a strong industry. As I mentioned, proper risk management is important, not only for individual institutions, but for the whole health of the industry. And I think that's kind of the future I see.
Good, and thank you for that. I certainly feel bullish overall for the community banking industry. We understand consolidation has always occurred, and certainly that will continue. I think the question is at what pace and what are the drivers. If I could press you to get a little more granular, is there a size at which a bank is just too small to survive today?
I think that it's going to depend on a lot of factors. I don't think you can put a pin in it. I do think it'll have to be bigger than what it was 10 years ago, 20 years ago. Just because if you think about what's happening, right, the costs of actually running a bank are higher, right? And you have to distribute those costs over assets. And so I think it'll be higher. But again, that doesn't mean that we won't have a distribution of sizes of banks in this country. And I think that distribution has really served the country well, and I don't see that going away. I don't believe that some of the hype out there, like, well, we're only going to see only very, very large banks. I don't think that's where we're going.
How about in terms of one of the pressures that we continue to hear a lot of, and even more so, increasingly it feels like the prudential regulatory agencies are focusing on what services banks should or should not do, and then whether fees can be charged. How does that correlate with the bank's safety and soundness if they can't charge fees or need to decrease fees on critical services.
Yeah, so I don't think that's the aim of the regulator, at least from the Fed's point of view in terms of supervision and regulation. What we're trying to do is make sure that the banking industry, individual institutions, as well as the overall industry remains healthy, because we really truly believe that a healthy banking system is important, plays a vital role in keeping the economy strong. And so the perspective is, I think focus on the right things, which are proper risk management, making sure funding, sources are robust and resilient. I mean, I think about what happened with the supply chains in firms, right? When they got tight and there was disruptions, they diversified, right, their sources of supply for their goods that they were making. Similar banks now, we're seeing them diversify some of their funding sources given the stresses that happened last year. So those are good, I think, regulatory perspective. That's a good move. So again, I don't think the perspective is to try to restrict banks. I think it really is the focus is on good management, being attuned to risk, making sure that you have robust systems and you're resilient, because no one can be prescient about what shocks are going to hit. What we can do is make sure we're prepared so that we can get through those shocks.
Still no takers. All right. I can go all day, folks. As a fellow economist, I can geek out on this stuff, so I'll just keep rolling here. Going back to monetary policy, with the emergence and presumably proliferation of cryptocurrency, how does that play into the decision making?
Well, it really doesn't play into the decision-making of monetary policy. I mean, right now, I think people think about whether it will ever play a role as a payment, service. I think right now it's a speculative asset, and that's fine. We have other assets like that. I would say that some of the technology behind it is very interesting. And, when central banks, there are a number of central banks that are investigating central bank digital currencies, understanding the technology behind it, and some of the technology behind cryptocurrency is certainly on the radar screen. As you know, in our country, right, we're not going to do a central bank digital currency unless Congress and the administration tell us they want us to do that. But we still need to be prepared to understand the technology. So we're doing some kind of technological, I wouldn't call it sort of a project, but it is sort of doing work so that we really understand the technologies and can understand sort of the impact on the economy. And that's kind of where we are on that. But it doesn't really feed into our monetary policy. We do have to be attuned to it, though, because financial stability concerns do affect us when we're thinking about monetary policy. So,
great, thank you. As far as when it comes to banking issues, is there anything in particular that keeps you up at night worth sharing with the crew here today?
Yeah. I mean, there are a number of things that we saw last March in terms of liquidity. I think, there's a lot of work going on in the Federal Reserve to try to make sure that banks are able to use the discount window, their position, and we've made a lot of progress on that in terms of banks now have the legal documentation in place, and they also have sort of collateral in place so that if they need to, they can use the discount window. And that was a concerted effort across the reserve banks to make sure that that happened. I have the privilege of being the chair of the banking of the payments committee at the Federal Reserve, which oversees payments across the Federal Reserve System. And one of the things that are under that committee is discount window lending. And so that's been an effort, and I think that'll continue to be true. On the other hand, I think, we were talking before, I think cybersecurity issues, and I would say operational risk in general, making sure that you're resilient to those kind of things, because that's not going to go away. I mean, and it's not really a risk. Those risks are actually being realized, right? We have a number of cases, right? So just making sure that you're resilient. And can your systems recover? Do you have data maintained so that you can recover from an attack? And that's not just for banks, that's for all firms, including the Federal Reserve. In our payment services, we've done tremendous work to ensure that our payment services are resilient. And indeed, FedNow, which I know that you know about our instant payment service, which launched in July. Another thing I should have said I was proud of, that we were able to do that project, and I think that could be transformative for the industry. I think those kind of things, we built it to be resilient, and that was, it's a cloud-based service, and it was built to be resilient. So I think that's got to be a focus of every institution going forward.
Great, thank you for that. Speaking of the discount window, am I picking up some perceptions correctly that the current administration would really like to see a greater utilization of that source as opposed to other funding sources out there?
Well, it's been an issue for a while that it seems to have a stigma attached to it. And of course, we would prefer it not have a stigma attached to it. We are there as a lender of last resort. We lend on good collateral, of course. But we don't want banks to shy away from that source. If you know, like the Federal Home Loan Banks, their regulator, FOFA, has come out and said, the Federal Home Loan Banks aren't really a lender of last resort. And the Federal Home Loan Banks would tell you the same thing. So again, we're trying to make sure that banks are understanding that we do stand as a lender of last resort, and that they don't shy away if they need a discount window loan. But they have to be prepared to use them, and that's what we've been working on. Okay.
Thank you for that clarification. I know we're big fans of the Federal Home Loan Bank of Cincinnati in particular. Appreciate Andy Howell being with us here today and the great work he and his team do. If I do not see anyone making their way to a microphone, Loretta, any parting words you'd like to share with us today?
No, just thank you again for all you're doing. It takes a village, as they say, and I think we're in it together. I sometimes worry that the banking industry gets maligned in some ways, but I have to tell you that it was instrumental working with the bankers during the pandemic to make sure that the economy stayed on an even keel. And if you think back to the beginning of the pandemic and where we've come, I don't know whether anyone would have predicted we'd be in this situation that we find ourselves in. So as I said, we're in a good place, and when we get back to price stability with healthy labor markets, we'll be in an even better place.
Absolutely. No, I like that perspective, and I totally agree. Just the resilience of the industry overall is incredible, and we need to make sure we're doing a better job at getting that word out. Certainly the banks in the OBL membership, thanks for all that you do in your communities. It's crucial work, and you are strong and really doing meaningful things there. So with that, I will thank you, Loretta, for being here today. Thanks for your service to the industry, continuing to keep it strong. And certainly was sad to see Steve Jenkins retire last week, but was glad to have one more opportunity to shake his hand and thank him. Definitely, whether it was the events of last year or the pandemic, we really were grateful for his steady hand and having good access with him and being able to tap him as a resource. So thanks for your leadership. If everyone would please join me in thanking Loretta Mester.
All right. Are we still on? Ah, it got shut off. Can y'all hear me okay? I'll just yell since this is not on. Again, I want to thank you, Loretta, for your time. As Ben Affleck said in good